Hi y'all, welcome back to my channel. Thank you for tuning in again. Today I'm going to be talking about some of the basic building blocks that go into building an investment portfolio. I've noticed that around me there are a lot of people who are talking about stocks and like investing in the market, and there's a lot of excitement, especially now that the market is just like super volatile. It's up one day and down the next, and it's easy to get lost in some of just the excitement, and also easy to feel left out if everyone around you has a Robinhood app and like checks the market every morning. So I wanted to spend some time, just a few minutes, go over some of the basics of investing in the market, some of the blocks that go into building a portfolio, because I believe that there's no one size fits all, right? I'm not going to come on here and say invest in stocks or don't invest in stocks, or invest in funds or don't invest in funds, because everybody has different risk taste. Everyone is at a different stage in their lives. Everybody has different financial goals that they're trying to accomplish. But I believe that we can all make educated decisions about our money. And that's the goal today, is going to be to try to shine the light on some of the blocks that go into building a portfolio, so that you can then go out and decide what you want to do. So these are just highlights. Be sure to do your own research and come up with the specific funds that you're interested in or that you think will work for you. The one thing that I always point out, and that I've found even in my own life, is that you should always understand what you're investing in, right? Some of the biggest financial mistakes I've made have been because something was hot and I was like, oh yeah, let's do it, without really doing my research. Maybe trusting someone else's judgment just because I trusted the person, or, just like brushing it aside and like, oh, you must take risk, right? Yeah, you should take risk, but you have to take educated risk. So I'm going to be talking about some of those things today. If that sounds like something that you're interested in, be sure to keep watching. You might as well subscribe now if you haven't already. And please share with your friends that might be interested in this kind of content. So let's get into it, right? So the basics are that generally when you think about the stock market, you think about going in to buy stocks, which are shares of the profits in a particular company. So you can go in and you can buy Amazon stocks, which you would be buying into Amazon as a company, or Tesla, which is one of the hot ones these days also. And what happens with that is, if the company is doing very well, then your stock tends to rise. But if it's not, then your stock tends to crash. And depending on depending on what was going on with the company at the time you bought, you might have bought high, and then the stock reduces its value and you would lose money in the process. Because all your money is invested in that one company, it's a really high risk, right? Because you're basically, the value of your portfolio is tied to how that company is performing. Now, the alternative is buying a fund, which is essentially a group of stocks that have come together. And by buying that fund, you're buying into all those different companies. Generally, there are two large groups of funds there are two types of funds that you can invest in. There are index funds and there are mutual funds. And I'm going to be talking a bit about some of what the differences between those two are. But the difference between investing in a fund and investing in a stock, obviously, is the biggest difference is your exposure to risk. By investing in a fund, you're diversifying your portfolio and reducing your exposure to risk. Because again, if you now come and invest in a fund that has, let's say, 100 different stocks at one particular time, it's very unlikely that all 100 of those stocks will be doing poorly, right? So what happens is that you don't lose as much as you would if you were invested in a stock that was currently on a dip, but you also don't make as much as you would if you were invested in only one stock that was currently on a rise. So it spreads out your risk. And for a lot of people, I feel like that works better. In general, I would say that you should have a significant portion of your portfolio in funds, index or mutual, depending on how you think about these things. and then a smaller percentage in stocks to expose yourself to more risk, to invest in things that you're excited about, and just to, gamble. It's not really gambling because obviously you want to make educated guesses about what you think that the various stocks are going to do. But in essence, my recommendation would be to put a large portion of your portfolio in funds rather than in stocks. That said, what are the differences between index funds and mutual funds, right? I like to think about the differences between those two in there are three main differences between them. The first one being who gets to decide what goes in the fund, right? The second one is what's the goal of the fund. And then finally, what's the cost associated with having an index fund or a mutual fund. So coming down to it, who decides what goes in a mutual fund is going to be the fund manager, right? Mutual funds are actively managed funds, which means that there's someone who is always monitoring how the fund is doing, how it's performing, which stock should be in the fund, and they're constantly taking and removing things out of it. They're constantly changing the percentages of whatever is currently in the fund. Whereas for an index fund is essentially a more passive type of investing. And in that case, the fund is basically defined by, the fund is not actively managed. The fund is defined by a particular characteristic. So for example, you could have an index fund that was associated with airlines, and that just means that if a stock is an airline, it's part of that fund. Or a very famous one, which I talk about a lot, is the S&P 500, which is an index of the Standard & Poor, which is an index of the top 500 performing companies in the United States. Just by virtue of being one of those companies, it's part of that index fund. So if you have an index fund that tracks that, it's essentially, you don't need someone sitting there and watching and saying, oh, this stock belongs in this fund or doesn't belong in that fund. By virtue of what that company is, it fits or it doesn't. So you don't have it actively managed. Now, that brings us to the goal of the two, what the differences between the goals for index versus mutual. So for an index fund, the goal is to track a particular index. So you're not trying to outperform it. Whereas for a mutual fund, you're trying to outperform what the market is doing. So if someone decided that they were going to come up with a fund that tracks the most innovative companies, the goal would be to, try to outperform the index that was tracking those. And so in theory, mutual funds is supposed to be doing better than index funds because they have someone who is actively managing them. That's not necessarily always the case, as I will talk about in a few minutes, right? And then finally, in terms of costs, there is a significant difference in the expense ratio of index funds versus mutual funds. As you might expect, because index funds are a passive way of investing, there's nobody who is actively managing them. They're much cheaper to invest in than mutual funds. So for example, the average expense ratio of index funds is about 0.09% of your earnings, versus the average for mutual funds is 0.82%, right? So what that means is if you were to invest, let's say $1,000 over 30 years and your return on that was 7%, if you were invested in an index fund, then you would be getting back, you would end up spending about less than $2,000 in fees. But if you were to invest that same amount in mutual funds, at the average expense ratio that I just mentioned, you would end up spending close to $20,000 in fees alone, right? So there's a significant difference between when you invest in index versus when you invest in mutual funds. Now, if your mutual fund ends up doing so well, you might not miss that money that you spend in fees, right? You'd be getting back the value for the money. But historically, it's been shown that only about 10% of mutual funds actually perform better than the market. So it begs the question, if you're paying more in fees and yet you're not getting back as much in return, should you really be paying that much? Should you not just invest in the passive? Should you not just carry on with your passive investing? So those are all things that come into play when you're trying to decide what should go into your portfolio. The way that I like to do it is be a standard passive investor, have a large chunk of my portfolio in passive investments, basically index funds, and then do my research on mutual funds, track the way they've performed in the past, and hope that that is going to continue to reflect on their future performance. And what that allows you to do is, try to pick mutual funds that have a long history and that have performed well over time. And then also pick mutual funds that are cheap, so that even though you're paying the fees on them, your return on investment is still good. And then I go out and pick a few stocks that I kind of believe in, right? And with all of these, I think it's really important to understand what you're investing in. Don't just sit and have your one friend from somewhere tell you, oh, I've just heard about this stock. This is the tracker. Go get some of it. And then you go and buy. Tomorrow, another friend from somewhere comes and tells you, oh yeah, this one is doing really good. This is the future. Definitely buy. And then you go and buy. Because in the end, you're just gambling. And while you might win some, you'll probably lose some, and your losses will probably be greater than your gains. So for what it's worth, just take the time, educate yourself about these things, and start to make more educated decisions about what works for you on a personal level, what works for your finances, and what your goals are, what kind of timeline you're playing around with. So yeah, that's what I wanted to talk about today. If you liked this video, please be sure to comment. Let me know what you want us to talk about in the future. There are more things that you should consider as you're building a portfolio, and we'll be talking about that some more later on. But let me know if you have any questions, any comments. Be sure to drop a comment below. Don't forget to subscribe and share this video with your family and friends so that we can all continue to have these conversations. Thank you for watching. See you next week.